decentralized money. That is the only thing that has gained any kind of market adoption.
Possible that the entire trajectory of technology would have been different.
This technology is still really about censorship resistance.
Let's initial innovations be truly globally accessible.
That we, as a crypto space, will onboard millions over the coming years.
Hey there, welcome back to another episode of the Blockcrunch podcast, the show for crypto natives. I'm your host, Jason Choi. And this week we have a highly requested guest, and that's Hugh Karp, the founder of Nexus Mutual. I was blown away by how in-depth and well-informed the questions are when I requested on Twitter for you guys to submit your questions for Nexus Mutual. And I'm very excited to dive into all of the burning questions that you have about this project. So today we're going to be diving into what Nexus Mutual is exactly, the specific mechanisms for its token design, as well as how it compares to some of the other projects that insures against different types of risk for people in DeFi. And finally, we're also going to touch on the elephant in the room, which is why does Nexus Mutual have KYC and whether this will be done away with very soon. And on that note, we also will be touching on the exciting pipeline for Nexus Mutual and the reasons why I think it will be one of the crucial backbones for DeFi. So make sure you listen to this episode till the very end. Now, as a housekeeping item, we do have one sponsorship slot open in the show. So if you'd like to get your product or your message in front of thousands of people every single week and get your message amplified to thousands more of crypto natives on Twitter, then let me know on jason@theblockcrunch.com. That's jason@theblockcrunch.com. And here's a message from our sponsor. Today's episode is brought to you by the good folks from Nexo. In this crisis, many investors aim to keep and grow their digital assets. Others seek to maximize the yield on their cash. Nexo allows you to achieve exactly these two goals. The company offers instant crypto credit lines against all major cryptocurrencies with interest rates starting from only 5.9% APR. Nexo also lets you earn up to 8% annually on your fiat and digital assets. What's more, interest is paid out daily. That means you can add or withdraw your funds at any time. So get started today at nexo.io. And as a disclaimer, I am a part of Spartan Capital, a crypto assets hedge fund based in Hong Kong. Nothing we discuss is Spartan's official opinion, and Spartan and myself may hold assets discussed in the show, but this is not intended to be financial advice. Blockcrunch also has sponsors who make this show possible, and sponsorships are not necessarily endorsements of projects. With that out of the way, let's dive right in. Now, Hugh, I think your talent and background is really rare in DeFi because a lot of the latest experiments we've been seeing that's been capturing a lot of headlines are often built by kind of greener coders and tinkerers. And there's often not a lot of vertical specific expertise, which has led to some pretty obvious blunders. But for you, you studied actuarial sciences. I was stalking your LinkedIn, and you spent almost a decade as an actuary in insurance, and then 5 years at a large insurance company before taking that lifetime of experience and expertise and applying it to building Nexus Mutual in November of 2017. So can you kind of start us off by helping us fill in the gaps here and tell us the story of why and how did you decide to launch an insurance product for DeFi, especially when DeFi was not the $6 billion giant that it is today?
Yeah, sure. So I guess a little bit of background on myself. I'm Australian. I worked as an actuary for various life insurance companies in Australia for about 10 years. And then moved to London and worked for Munich Re for about 6 years, doing various roles in the life insurance industry. So, typical corporate insurance gig. Left Munich Re. My role at the end there was the CFO for their life operations in the UK. So, ran a decent sized team and balance sheet and all that stuff and kind of know the insurance world. I guess I'm a bit different to some of the other founders or people building DeFi stuff. I guess I kind of went down the Bitcoin rabbit hole quite a while ago now, 2010. But I thought it was fascinating. I really thought it was really cool that you could send money to people without anyone else in the middle. I didn't really know how the tech worked, but I kind of just dug in and kind of found it fascinating from a use case point of view. But I guess I put it down after year and a half or something. Didn't really know what to do with it. It wasn't kind of my expertise, I guess, payments. And so yeah, I kind of went along and kind of left the space, I guess, temporarily. And then about a year after Ethereum launched, I heard about it again and kind of decided to just dive in and start investigating stuff. And I guess once I kind of figured that you could do if-then statement that then you could do an insurance contract. So how could we make this work, and how could we kind of put together a DAO type structure, which is kind of like what mutuals are, like, just mutuals have existed for millennia. And it's just a group of people sharing risk together and coordinating together, and like tokens and the DAO structures and stuff can really coordinate people, and we can kind of supercharge that process and scale it. I guess is the thing that we're trying to do. So I guess I use my expertise to kind of know how insurance works and kind of map it onto how you could make a kind of DAO running on Ethereum work in a similar way. So we're kind of not doing anything new from that point of view. Like these structures exist, and using kind of economic incentives and kind of revamping that type of thing. But like the fundamental structures are nothing really that new. But I guess I've always been kind of fascinated with the kind of social aspects of things and like actually helping people. And I guess I got a bit jaded towards the end of my time in the insurance industry, where kind of just felt like we were moving money around balance sheets and not actually helping the real person down the end of the line. And so that's kind of what we wanted to do.
Got it. And now at a high level, Nexus Mutual, as you said, it's a DAO that provides insurance. And did it start off as a DAO that provides insurance specifically for DeFi, or were you thinking of kind of outside of crypto back then?
Yeah. Okay. So specifically, I'll just clarify this one up front, just to get it right. We don't provide insurance. We're a discretionary mutual, and so we provide what's called discretionary cover, just making sure we get the legal and regulatory stuff right up front. But in essence, we kind of built the mutual with the intention of providing like cover for earthquakes or hurricanes or something like that outside of DeFi. But we were building this generalized structure that we could offer any product. And then I watched the DAO be drained live. So all the messages come in, and logged on and was just watching Etherscan and all the money going out. And I was like, okay, wow.
Jesus.
If we're going to actually make this new economy work, then we need cover for this type of stuff. And so that's kind of when we decided to pivot on the product side and build something that we kind of just thought was a key risk in the space, that if things were going to progress, then we needed to address. And so that's kind of where it came about. And I guess, we launched May 2019. And obviously other stuff in DeFi has been building, and I guess it's kind of all come together really recently, and our product's really kind of taken off over the last kind of month to 6 weeks, especially with yield farming and DeFi getting a bit of a resurgence. So it's been great to see.
Yeah, and what terrifies me is the amount of risk that people are willing to put on when they kind of do these yield farmings. You have billions of dollars locked in these unaudited contracts. So that's why I'm very excited for something like Nexus Mutual. So before we deep dive into the protocol itself, at a high level, can you kind of describe just how it works, and what are some examples of the type of kind of discretionary protection, in your words, that DeFi users can purchase today?
Yeah, sure. So just a very high level on the kind of economics and how it kind of really works. There's basically one pool of capital, which is predominantly Ether right now, some DAI, that the mutual members kind of jointly own. And so all of the cover purchases, the fees from the cover purchases go into that common capital pool. All the claims will be paid from that capital pool. The capital pool will also earn yield in the future. Haven't kind of enabled that bit yet, but it will. And so that's kind of owned by the DAO members. And then over the top of that, we have the NXM token, which is basically an incentive layer to make sure we kind of use the capital pool in the right way. Pay genuine claims, make sure we can price things and govern other elements of the system. So that's kind of like the really general structure. And then in terms of the product and the specific product we have right now, it's smart contract cover. It's probably best described as Solidity cover. So basically it covers against the bugs or the hacks in the Solidity code. So that's kind of like the technical risk. I guess there are kind of a few other types of risks that aren't covered right now that we're looking to expand into in the future. And those would be things like anything outside the smart contracts. So something like an Oracle failure or a governance attack or something like that. And I guess the other larger class of risks that may not work would that may cause an issue that we don't cover, like economic failures. So something like you have an economic design system that's supposed to, like, DAI is supposed to be pegged based on the economic system of incentives behind Maker, but at some point that may not work for some reason. Maybe the ether price drops too fast or something, and then DAI doesn't hold its peg. So something like that isn't covered either. But because the smart contracts may still just be working. So that's kind of right now, but yeah, definitely looking to expand and broaden the coverage. So we kind of wanted to start with something simple first, and then go from there.
So just to clarify, currently Nexus Mutual covers for only smart contract failures, right?
Yeah, that's right. The technical risk of the smart contract failures. And so I just kind of outlined the other stuff that we don't cover right now, so people have some idea. But also the fact that we're looking to include it more and provide comprehensive coverage in the near future.
Got it. And now let's kind of dive deeper into the protocol itself and kind of how it works. And typically for this part, I will kind of monopolize your time and ask all the questions that I personally have. But this is probably one of our most anticipated episodes lately, and the listener questions just kept piling in the past 12 hours. So here are some of those that I will try to rephrase and post to you in a coherent narrative for the rest of the episode. So let's start with the basics first. So Nexus currently provides cover for, I think last time I counted, around 30 or so projects. So can you tell us kind of just how risk on these projects is assessed? Because if you're covering for smart contract risk, how do you know how secure a smart contract is? And how do you price the risk of a smart contract failure?
Yeah, so basically we do this on a decentralized basis. So we have a pricing algorithm that basically it gives you a price based on how many people have staked NXM against that particular contract. So if there's a new contract that gets launched and we just kind of add it to the Nexus UI so people can interact with it easily, then no cover is offered unless someone stakes NXM against it first. So they want to back it. And so the more NXM that is staked, the lower the price and the more capacity, so the more cover can be bought. And so that's basically how it works. It's kind of using prediction market techniques to determine what the price is. The idea here being that at scale that we have sophisticated actors that can run off-chain information, do tests, and run like code tests and do audits and those types of things, and understand what the risk of the smart contracts actually is. And then there's a financial incentive for them to earn returns because the stakers earn when people buy cover on the particular contract, and so they have this incentive to stake against good contracts and not stake against bad ones. And so we're kind of using prediction market techniques to price essentially.
Got it. So the risk of these contracts is basically a function of how many people are willing to stake their NXM tokens behind these contracts to basically underwrite the risk for them, right?
Yeah, exactly. That's right.
And can anybody come and list new markets? So if I, for instance, launch a new DeFi protocol and I'm pretty confident about my coding capabilities, so I want to offer cover on this thing, can I just go on Nexus today and offer cover?
Technically, you just have to ask us to just put it on the UI, but we're going to be enabling people to do that on a decentralized basis in the future.
Got it. And as a follow-up to that, right, because lots of DeFi projects you see today plug into each other and may in fact compound risks. And this is what's called composability by a lot of Ethereans. And it basically refers to how, something like Augur, for instance, could be using DAI, which is, another project, and could be using oracles from Chainlink or some kind of plugging into different DeFi primitives, and each of these primitives have their own risks. So how do you factor in composability risks into your products? Is there any type of risk that, if one product that many other projects relies on falls apart, then there's a cascading failure?
So right now we manage that by basically covering each system on a system basis. And that means that we put caps on the amount of cover on a system basis. So we're kind of separating things out because we realize that's an important thing to manage for the health of the mutual as a whole. So the key here is that what we want to do is diversify risk in the mutual, because that's how mutuals work best, because you want to kind of under collateralize, because that's the most capital efficient. Perhaps we'll get into that in a bit later. But the main downside of actually doing under collateralization is you need to manage the correlations between risks. So the relationship between this risk may have an issue, but that also means another one has an issue. And so that's the complicated problem to solve. Right now, we're kind of solving that by splitting things up quite in a delineated fashion. So you have to buy cover on compound or curve or something separately. What we want to do is offer like composed products that cover like the full stack of risk. But that means we then need to manage the capacity limits on those particular stacked risks to make sure that we're not taking on too much risk or accumulating too much risk in a total fashion. And that's a bit more tricky, and we have to work out how to do that via governance. But that's the kind of balance that we need to strike, and is perhaps one of the more challenging aspects to manage as a whole.
So currently, is it a fixed amount of cap for each project, or is that cap kind of dependent on how risky the project is as reflected by the stake?
So it's that there are two limits. There is a limit based on how much is staked. So you can never, so that's kind of the first one. And then there's a global limit. It doesn't matter how much staked, we're never going to take on too much risk relative to the capital in a mutual. So there's basically two limits, and the lower of which applies. So for a new protocol, it's likely that the amount staked is going to be the first limit, and that's going to drive things for a while. And then as it becomes bigger and more people stake, it's likely to hit the global limit, which just makes sure that the mutual doesn't go bust after one claim, basically.
And who do you think are the most common type of people who stake, who provide, who underwrite the risk and provide coverage on Nexus? Is it the project teams themselves, or are there any incentives for project teams to provide cover on their projects?
So the project teams themselves are actually have multiple options to getting involved. Some of them buy cover on their own contracts, kind of like on behalf of early users to kind of help bootstrap stuff. Some are staking against their own contracts, so it's cheaper for their users to buy cover themselves. And some are also considering providing farming, yield mining bonuses to Nexus stakers. And that's not quite live yet, but that's coming soon. And so they're considering providing bonuses to Nexus stakers that stake on their contracts. And so that kind of helps the bootstrap phase for new projects, and helps those projects attract liquidity themselves, because the liquidity providers can get cover on Nexus. So there's kind of definitely a few options there, and different projects are taking a different route as to what makes the most sense for them.
Yeah, I do think that idea about kind of incentivizing users to kind of stake behind the contracts they use is really powerful, especially because we've seen, I think there are a lot of extreme examples lately with yield farming, but at the core, the fundamental idea is still very sound. It's basically incentivizing people to use certain protocols. And we've seen protocols that incentivize usage on other protocols as well, with things like Curve and Ren. So I'm very excited to see that happen. And touching on that point, right? So claims currently on Nexus are processed by human governance. So meaning NXM holders vote to see what claims will be approved and what will be rejected. So what I like about this is that it allows for flexibility to cover for pretty much any type of risk. As you mentioned, there are many other types of risks that Nexus could be covering. But that being said, stakers are still underwriting the risk, and they're on the hook if they have to kind of pay out some of the insurance. So is there an incentive for people to reject the claims, and how will a claim from a popular smart contract ever be granted if most users on the platform stake in that same smart contract?
Yeah, so I guess the claims engine the claims voting system is kind of key to what we're doing. And one of the key things here is you have to kind of align incentives. And at their heart, you can see that there's a misalignment, because some people, you want to pay the claim, but because that's what you've agreed to, but there's obviously a short-term downside. So the way you actually align incentives in this scenario, in this situation, is you actually push the incentive alignment to the longer term. Because if the mutual never pays valid claims, or doesn't pay a clearly valid claim, then it has no value. And so no one would buy cover in the future. And so therefore, the way we kind of do this is kind of, we make sure that the stakers on the claims are kind of locked up for a period of time. And so they have this kind of longer term incentive. But that's kind of I guess that's kind of more a softer, it's not a direct hard incentive mechanism right at the start. So there's that's kind of the first one, and then the second one being the hard incentive, which is basically the 5 advisory board members in Nexus can't decide on claim payments, but they can decide to potentially slash claims assessors' bonds if they believe there's kind of malicious voting activity, clearly declining claims or clearly approving claims that shouldn't be approved. And so we have to work out how to exactly kind of more decentralize that process in the future, because that's kind of not where we want to be long term. But that's kind of how we launched to start with, because it's actually quite a hard problem to solve. And so that's how we've done it right now. It's working, in my opinion, so far. Obviously, we haven't had a massive claim to pay out, so it still has to be tested. I'm not saying it's absolutely perfect. We did do quite a lot of work on the modeling of this. We even got it kind of attacked with simulated AI agents that could bribe each other out of band to try and extract money from the system, and it held up quite well in those circumstances. So yeah, it's core to what we're doing. It's more complicated than a programmatic payout, but it's inherently much more flexible. So it's definitely a trade-off there. But this type of system works in the real world. There are discretionary mutuals that essentially they have all their members voting on what claims are valid, and it does work. We're kind of automating it, I guess, but and it's, there are obviously some differences, but that's kind of key to our success, and it's one thing we're very, very focused on.
And this 30-second intermission is brought to you by our sponsor, Nexo. Depending on what type of company you're operating, Nexo can help you in different ways. As an exchange, they can be a strategic partner. As a miner, they will offer you OTC credit lines to help cover expenses. And as a crypto fund or any type of institutional counterparties, they can offer you a portfolio of structured financial products and up to 8% annual interest on your idle stable coins, as well as asset swap agreements or direct borrowing off crypto. Individuals can also park their cash and stablecoins at Nexo's interest earning account to get an annual rate of 8%. And what's more is that you can actually claim this interest every single day, and you can add or withdraw funds at any time as well. So if this sounds interesting to you, get started at nexo.io. Got it. So it sounds like it's 2 main incentives for people to kind of approve these claims. One is the long-term health and value growth of the Nexus Mutual itself, which is kind of the carrot. And then the stick is you have these 5 advisory board members that can slash stakers if they think they are kind of not approving claims when they should be. So obviously there would be some, concerns about the latter when it comes to centralization, especially in the DeFi crowd. So can you maybe go into some detail about how you think decentralization could look like for that advisory board?
Yeah, so essentially there are a couple of functions within the mutual that need to be kind of governed on a longer term basis. This is that claims slashing is one of them. The other one is what we've mentioned before, which is like the managing the correlation risks and stuff like that. So as an example there, it may short term, it may make sense to have as big a capacity as possible because then you sell some business, but that may end up with too many claims later on the line. So you have these functions like the claims assessment slashing and the correlation management that really need to be long-term focused. And so what we're looking to do is, and one kind of tangible idea that we're working with, is to have a role within the system that anyone can perform if they lock their tokens for a very long period of time. And so their incentive alignments is like, say you lock your tokens for a year, that gives you the right to potentially slash claims assessor bonds and set these correlations and capacity limits on that type of stuff. So that's the type of thing we need. We need kind of call it a technical group of long-term focused people that are really looking at the health of the mutual as a whole, and then we need to kind of foster that group. At the moment, that's a specific group of 5 people, but we need to grow it and decentralize it further in the future.
And do we know who these 5 people are, or are they anonymous for security reasons?
Oh no, they're perfectly. They are well known. They're on the company's house on the UK. They're listed as directors of the company. And they're on our website and stuff like that, so everyone can look them up.
Got it. That's awesome. And let's kind of shift focus a little bit to talk about the long-term moats of Nexus Mutual, since we're talking about the long-term value growth. Now, one thing that I thought was interesting when I was trying to do my little research into traditional insurance is that premiums can be lowered by bundling. So you can purchase cheaper insurance if you bundle kind of different kind of programs together. But is there such a network effect to Nexus Mutual? Do you foresee kind of premiums lowering if people purchase multiple discretionary covers on the platform?
Not as much. Basically, the bundling effect. The reason you can offer the discount is because you have a fixed cost that is spread across those. And that's kind of like usually the administration expenses and stuff like that. But the risk cost, as in the cost of claims, is just simply added up because you're just taking that on. So generally, the way those discounts are justified in the insurance industry is because you have a large fixed cost base and you're only giving 60% or less back to the customers in claims, you can spread the remaining 40% across stuff, so you can afford to offer discounts. So Nexus doesn't quite work like that. So I mean, there are going to be some level of fixed costs, but it's likely to be less material, and the users and the members will get the benefits via lower premiums directly. So definitely a possibility, but the economics don't quite work as well as they do in the insurance industry.
So are there any economies of scale to the Nexus Mutual design?
Yeah, so versus the regular insurance industry, we expect that we can strip out at least 50% of the cost base versus what they're operating on. So, have claim ratios that instead of handing, 60 cents in the dollar back, you can hand 80 cents in the dollar back effectively. And not only that, rather than the profit going to the equity holders or the shareholders of the insurance company, because it's a mutual, it all goes back to the members. So, via the essentially via token appreciation and the XM. And so that's kind of everyone who's involved in this thing kind of shares in its success. And that's kind of the key part of it.
And just so our listeners can understand, can you kind of elucidate on that example you brought up with the 60 cents per dollar and 80 cents per dollar? What do you mean by that?
Yeah, so if you pay a premium for an insurance contract, say you pay $100, then on average across all users, some people obviously get a claim back and other people get zero. But if you average it out across everyone that holds the policies in their big group, generally the insurance companies pay back about 60% in claims. And so the remaining 40% essentially goes to administrative expenses of, sales processes, everything in the value chain and the profit margin for the insurance companies. So that's kind of how that's kind of how the economics work. You kind of overpay for the risk because you have to pay for the expenses. And so what we're saying with Nexus is we're much more efficient. We can cut out a whole chunk of those expenses, and not only that, the profit goes to the members rather than to the shareholders of the insurance company.
Got it. So it sounds like the Nexus Mutual model has a huge benefit over kind of the traditional insurance model in the sense that the cost basis for operating this mutual is a lot lower.
Yeah, exactly right. And I think, I guess so cost base is lower, and then because it's a mutual, the members get the benefits rather than the shareholders. That difference exists in the real insurance world right now. But the challenge is with mutuals is they struggle to scale and grow large and get economies of scale because generally you need capital to scale, and the members of a mutual generally don't have a lot of capital. They're just people that want insurance. And so that's one of the reasons that and mutuals can't access capital markets to inject huge amounts of capital. Whereas what we're doing here is we're kind of allowing, because we have the token, we're kind of allowing capital flexibility into the mutual. And so we can make the mutual model scale. And that's kind of one of the key fundamental principles of what we're trying to do, and the benefits of having a token that can allow this scaling process to happen.
And just to put this in the user's perspective, so say I have, say, $1,000 staked on the YAM protocol, which is, unaudited, and I want to buy cover for all of the $1,000. How much would that cost me roughly? And how does that compare to, say, if I want to buy insurance on my car? Or is that even a fair comparison at all?
It's a reasonable comparison. I don't actually know the answer on the car off the top of my head. But I can give you. YAM was an interesting short story. Well, I mean it's ongoing now, but the initial V1 of YAM. So YAM went live, and then a little while later, after we woke up, we added it to our user interface, and that kind of allowed people to stake. And then only I think one person staked and just put about $1,000 worth of NXM on it, and so that meant the price was really really high. So it was like 90% per annum or something for a cover. And you could only buy a small amount of cover, and so no one actually bought it at that point. And then the bug disclosure was made, and that was kind of the end of the story. So I guess that's kind of roughly just gives you an idea of how it works. Ideally, that it lasts for a bit longer than that, and more stakers come in, and then the price comes down, and it's a bit more reasonable. But yeah, so I mean, to give you some perspective, like to buy cover on Compound or make a kind of they're kind of the ones that are more heavily staked, and they're kind of 1.3% per annum. So yeah, if you want $1,000 worth of cover, pay $13 a year.
And how does that rate compare to like traditional insurance? Kind of just roughly, is it in the same range, or is it kind of much cheaper?
It definitely depends on the particular product that you're talking about. It's probably it is probably more on the more expensive side for some things, but definitely, yeah. Look, it is. I'm trying to get some reference points in my head, so sorry for being a bit slow. But like life insurance, it would be cheaper than that. Car insurance is probably about the same.
Got it. I guess that makes sense because this is also a proprietary product, right? You can't buy insurance on Compound with any kind of major insurance providers today. So it kind of makes sense from a market perspective for there to be somewhat of a premium, at least for now. And it sounds like that premium will also go down over time as more people stake too.
Yeah, I mean, exactly right. I mean, the whole premise here is that if there should be a market economic balance thing from the staking and the rewards and the risk, obviously involved. And to be honest, like smart contracts, especially new ones that have just been deployed, are quite risky relative to driving your car.
Yeah, and with the YAM example, even at 90% APY, it actually might have been worth it because it failed in a day. So yeah. You actually end up covering yourself pretty safely. So that's what's so exciting about kind of DeFi insurance, because the risks are so much different. And I want to kind of pivot a little bit to talk about, I guess, an elephant in the room as well, which is to participate in the Nexus ecosystem, you need to do KYC. So I know a lot of people have talked to you about this, but the process itself was actually really easy, right? It took me like 3-5 minutes to do it, but it's also understandable that many in DeFi don't like KYC. In fact, a lot of people probably came into DeFi because there's no KYC. There's kind of real permissionless insurance. So can you talk about the kind of rationale behind why is there KYC, and is there any plan to kind of open Nexus up to a kind of a non-KYC or permissionless setting?
Yeah, no, it's a fair question. Just to be clear, I hate having to have KYC in there. It doesn't sit well with me, but it's kind of a necessary evil right now. So to be honest, we have KYC because Nexus itself is a legal company in the UK right now. And so it's kind of like a DAO wrapped in a legal entity. And the reason we did that was because insurance and is a highly regulated space. And so what we wanted to do is make sure we get out to market in a safe way. We're essentially following a structure, a discretionary mutual that's a well-known existing structure, and essentially we're automating that with smart contracts on Ethereum. So from a legal and regulatory point of view, we're following a known model. Now, I guess the other point to note is that there are some elements of the system that aren't fully decentralized right now. We have the claim slashing. There's the capital model that gets run off chain once per day. The pricing models run off chain just for computational reasons and stuff. And we have plans to kind of put that on chain in the future in a done fully kind of decentralized fashion. And so as we will kind of work through that on a progressive decentralization basis, there's going to be an option at some point for the mutual members to vote to get rid of the legal wrapper and go to a fully permissionless basis. But we kind of want to decentralize some stuff first. So this is a progression. We want to make sure we're doing things in a safe way. I agree. It kind of jars with the pure DeFi. I guess viewpoint, and it jars with me as well. But it's kind of the route we're taking on our progressive decentralization path.
Got it. And I think that's actually probably more common than most people think. And I personally of course, prefer kind of completely trustless and permissionless protocols as well. But for something like insurance, I'd rather prioritize security at first, before kind of complete permissionlessness, because this is kind of the last line of defense. If something fails on one of my kind of DeFi yield farming farms, then I want Nexus to, I want there to be some accountability there, and I want to know who I can talk to, at least in the initial phases of the project. And as you said, it's only launched May 2019, right?
Yeah, exactly. I mean, kind of weird way, we have to build trust. Even though we're doing smart contracts, we have to build trust in the system and the fact that it works, and so we need to do that as a gradual basis. And like insurance has a lot of more complicated mechanics than other kind of DeFi protocols out there, and so we have to kind of balance them. It's always a balance. There's always trade-offs. There's no kind of clear, correct, hard answer in a lot of this stuff, and so we have to make sure that the incentives work and the whole thing kind of gels together. And so we don't want to just rush out there, fully open the protocol, go nuts, and potentially have big problems. So we want to do this on a I guess steadier basis that makes sense and build that trust over time. And when the time's right, we can address the kind of legal entity and the KYC and stuff.
And I think on that note, I think that the market is starting to realize that insurance is going to be an increasingly important kind of primitive in DeFi, just because of the rapid growth in total value locked and, of course, the requisite increase in risk as well. So we start to see some competition, and I think this week we saw Earn Finance launch their own insurance protocol as well, and they are opting for the kind of completely permissionless, kind of testing the code in production kind of mode. So almost on the other end of the spectrum when it comes to risk compared to Nexus Mutual. So I'm curious, have you looked into the Earn model, and what are your thoughts there? Is it a competitive threat to Nexus Mutual? Is this complementary? And what do you think about that?
I definitely think it's complementary. We know Andre. We've been talking to him. He's doing some really cool stuff. He actually knows a bit about the insurance world as well, which is great. But I think the important point here is it's actually quite hard to design these economic structures on the insurance side and make sure that they're capital efficient and work. But I don't know if you saw his more recent tweet, but there's definitely a way to make these things work together. For example, YN can take the first layer, and the second layer of risk, like a reinsurer, can be covered by Nexus. And so they're actually complementary and can work quite well together. And Nexus can cover the back end Black Swan type stuff, and the YN stuff can cover more, smaller ongoing things. So, there's definitely ways to partner and complement these things rather than it being a direct competitor.
Got it. That's awesome. And I totally empathize with the point about insurance being hard to build, because I was wondering why we see so many DEXs in the beginning of the kind of DeFi cycle, so many AMM clones and variants of AMMs like Uniswap. But there are not a lot of options protocols, and there are not a lot of insurance protocols, because it seems like to design those things, it takes another layer of complexity and kind of modeling risk, kind of managing liquidity, introducing incentives. And I haven't really seen a model that does it well live yet, besides Nexus. That's why I'm very excited for the project. And kind of touching on value of the system as well. Now, this is not a trading podcast, and we don't really talk about, short-term price speculation, but value accrual is actually key for the Nexus Mutual, the growth of the Nexus Mutual. And what I really like about it is that the token is unlike most tokens. It's not just a random coin that's going to be listed on Binance and people shill it and pump and dump and all that stuff. It's actually fixed to this algorithm that is directly tied to the performance of the mutual itself. So people who are holding the Nexus Mutual token know exactly what they're betting on. They're not betting on memes. They're not betting on people kind of speculating. They're betting on capital inside the mutual and excess of the capital. So I think this part has actually confused a lot of people. So can you maybe help us break us down? How does that work exactly? How does that token accrue value?
Yeah, sure. I think the most important point here is, so the token runs on a bonding curve, so it's formula driven, as you said. And what we're actually trying to do here, like at a really high level, is make sure the mutual always has enough capital to be confident it can pay claims, but discourage excess capital that it's not putting to use. And so what we want to do is grow the capital required in line with the business growth. So that's kind of the main point. Like it wouldn't make any sense for us to do like a massive ICO at the start and sit on hundreds of millions of capital that doesn't actually do anything until the demand caught up. And then say it eventually did, then we may not be able to raise some more capital to support it. So we want to kind of grow the capital with the demand. And that's kind of the main point. And so the point here is like everything is being done for the good of the members, really. So that's really what it's doing, and everyone's sharing risk together. And so I guess what that means in terms of the token model is we have this concept called the MCR, or the minimum capital requirement, and that's basically how much capital the mutual needs to back the covers it writes. And so the more it writes, the higher that gets in the long-term basis. It's not quite doing that right now, but in the long-term basis, that's what it will do. And so once we have that concept in play, then we actually compare that to the assets that the mutual actually has at this point in time. And that's then we have this concept called the MCR percentage, which is basically like a solvency margin. So, if we have 50% more capital than we need, the MCR percentage is 150%. And the higher that ratio, the higher the token price. So the whole idea here is if we have excess capital, the token price goes up, which encourages people to destroy the NXM token and take money out of the mutual so that we're not sitting on excess capital. Conversely, if we have a few large claims or the capital position of the mutual drops, then the token price drops to encourage it to be recapitalized and get back up to a safe kind of good margin to make sure we've got enough capital to pay claims. So that's as simple as it really is. It's kind of the short-term price is driven by the ratio of the funds that we have versus the funds that we need. And the long-term ratio is specifically linked to the adoption of the platform. And we think that that's kind of the mechanic that we've really designed the mechanic from a point of view of supporting a healthy growing mutual rather than a coin that can just pump or whatever. Like it's kind of built from that purpose rather than just here's a token. So that's kind of where it's come from.
Yeah, absolutely. And as kind of fundamental investors, I really appreciate that because there's things that I can actually study and I actually know what I'm kind of betting on if I hold any NXM token. So this is really interesting, and I'm curious about, how did you come up with that idea? Did you look into other bonding curve projects? I'm not sure if Uniswap was around when you first conceived of Nexus Mutual, but how did you kind of come up with that?
Yeah, so I was basically had this problem, and in terms of like being able to gradually grow the capital over time, and then Simon de la Riviere, he put out his first post on bonding curves, and I just went massively deep on that stuff. And so we had our bonding curve and we're testing it and stuff even before Uniswap was released, like probably about 18 months or something before Uniswap was released, in fact. So we've been studying these things for a while, and we've written simulation models and made obviously changes to the token mechanics. Like we first had supply of the token in there because that was kind of one of the key things that most bonding curves use. And then we actually did some simulations and took it out and everything was a lot stabler without it. And so, we've been doing a lot of work on them for a while, but that original post by Simon was kind of the inspiration behind it.
Got it. Well, this has been an amazing discussion. I think we touched on a wide variety of topics from the background of Nexus Mutual to how it works to how kind of the token model works. So hopefully that clears a lot more up for our listeners. So next up, can you talk to us about what's on the pipeline now? I see a lot of things being discussed on the governance forums, and you did mention that there are efforts to decentralize the advisory board, maybe decentralize the KYC process, and recently there's also been the launch of Wrapped NXM as well. So can you kind of talk about what have been the recent milestones and what are the things that excite you the most on the pipeline?
Yeah, so in terms of like the future stuff we're really kind of looking at, like it's going to be more on the product side and making small enhancements, things like covering stacked risk, making that really easy. A bit more longer term partial claims, which kind of is like a fundamental thing that we want to enable so that it gives us much more flexibility on future products. And then we can start rolling out future products relatively easily, like, slashing risk on staking networks, centralized exchange cover, that type of stuff. And I guess also a key one on our roadmap is really the enabling of the mutual to earn yield. And so we have some solid plans on that, and that's going to be a key thing because that really benefits members. We're going to just sitting on the capital, and we can actually put it to work as well as back the covers. So that's kind of some really interesting stuff. And then longer term, as we kind of work through these things, it's going to be decentralizing the different mechanics piece by piece, and then we can then we have the option of kind of getting rid of that legal wrapper if the members want to. It's going to all be up to them.
Got it. And just before I let you go, Hugh, if people want to kind of follow what's going on with Nexus Mutual, follow your latest work, and even participate in the governance discussions, what are the best channels? What's kind of one or two places that they can go to find all these resources?
Yeah, you can start on our Twitter, but our Discord's probably so Twitter is at Nexus Mutual, and then you can go to our Discord from there. The Discord's the place where most of the conversations and stuff is happening, and then the more technical discussions are happening on our forum, so you can kind of link to the forum from our Discord. But yeah, Discord's probably the place to start, and then we're looking for more kind of definitely technically minded people to get in and discuss these things because there's some complicated stuff here in the insurance world, and being able to have more minds looking at it rather than the handful of people we have now is going to be really valuable for the long-term health of the project.
Yeah, absolutely. And if you've listened to this episode up to this point, it probably means that applies to you. So I'll definitely link that Discord link in the show notes below. And thank you so much for coming on to the show, Hugh.
No, thank you very much, Jason. It was great to chat.